Hello and welcome. Today we are analyzing General Mills, ticker GIS. Over the next few minutes, I'll discuss both my thoughts on the valuation of this company and its business quality. We have a market cap of $46 billion, enterprise value of $54 billion, so you see about $8 billion in net debt on this business, otherwise about 15% of the overall enterprise value. Pretty reasonable. Industry is the food products industry. So General Mills manufactures and markets branded consumer foods worldwide. That key word here is branded because branded consumer foods tend to have a relatively higher price and higher gross margin. That tends to be quite helpful for the business operations. They have 5 segments: North American retail, convenience stores, European, Australia, Asia, Latin America, and pet. So they offer cereal, yogurt, soup, meal kits, refrigerated frozen dough products, dessert, bakery mixes, bakery flour, frozen pizza, etc. Here's some of their brands, it looks like. So we have Annie's, Betty Crocker Bisquick, Blue Buffalo, Blue Basics, Blue Freedom, Boogles, Chex, Cinnamon Toast Crunch, Cocoa Puffs, Cookie Crisp, Fiber One, Fruit Gushers, Fruit Roll-Ups, Oatmeal Crisp, Gold Medal, Golden Grams, Haagen-Dazs Ice Cream, Old El Paso, Raisin Nut Brand, Lara Bars, Liberté, Lucky Cheese, or Lucky Charms, Nature Valley, Wheaties, Yoplait. Very strong trademarks, brands. I've certainly heard of quite a few of these brands. You've probably heard of some different ones than me even. And so they sell directly as well as through broker and distribution segments. They also have leased and franchised ice cream parlors. That's interesting. So one of the things that I look for that screams out here is that the beta is 0.32. This is one of the lowest betas I've seen of the companies in the S&P 500 that I've reviewed. The lower the beta, the less volatile the stock is, which tends to be a sign of a relatively high quality business. And here, 0.32 means it's 68% less volatile than the average S&P 500 company, which tends to be a very strong sign. Now, return on invested capital also is telling me this is a relatively high quality company as well. You have 20 straight years of profits, and there's no clear cyclicality in this business. You don't see these up and down cycles marking tops and bottoms. You do see some bottoms here in 2015 and 2019, but on an average year, the year-to-year change is relatively low. If you just look 2016 to 2018, you see 10.5%, 10.3%, 10.5%. Very, very stable year-to-year return on invested capital. It means it's a relatively more predictable business. Likewise, you see that their lowest year in terms of profits is, around 7%. So around 7% 2003, 2015, and 2019. And their peak returns on invested capital are in that 13% range. So they're really hovering around this 10% average, which is what we see here on the 10-year median returns. 10-year median return of 10.3% for return on invested capital meets my metric for 10% plus return on invested capital. And the return on equity of 25% is well above my 15% target. So everything here is aligning to say, hey, this is a high quality business. Likewise, you can see that although their gross profit margin is only 35%, they're converting at a very high rate to still having a 16% and 13% EBIT and free cash flow margins. That is a good sign at how rapidly they're turning those gross profits into free cash flow. You would probably find many companies with gross profit margins of 35%, but they might only have single digit operating margins on these lines. And so that's actually a good sign there as well. Now, when we get to valuation, we see a very reasonable valuation ratio of PE of 16. PE of 16 is quite a cheap price. It's quite an average price. You're talking about 6-7% earnings yields. It's a very good starting point, especially when you combine that with something like an EPS growth of 6.5%. You're in a very good range for hitting a double-digit type return. The only downside here is that your revenue growth is only 1%. That's actually quite low. You can see they grew from $17.7 billion in revenue to $18.9 billion in revenue. So it's very little growth left in this business. And that is somewhat of a concern for me because I really want to see a company that has much bigger growth runway. But the big point here that we're going to have to dive into is how did they grow the revenue at 1% but grew their EPS at 6.5%? There's a 5% gap there. Most likely there's a decent amount of buybacks, which is actually a really good way for the capital allocation. And those buybacks can be even more effective when you're trading at reasonable PE ratios like 16. So far, high quality business trading at about an average price, but there is relatively lower growth than I would normally like to see. One of the key points here is gross margins fairly stable. You see it's in a very tight range here from 33 to 36%, and it kind of stays tightly within the range that whole time. Your operating margin actually improves across the decade from 16% to 17%. Not a significant jump, but it is an improvement. Now on the EPS line, again, we grew from 279 to 442. Let's just check that against. Yeah, so we can see that kind of matches up. There's no real distortions here on the price line that's saying, hey, this pre-P&E ratio is quite off. One of the things that's useful there is kind of checking if these last 2 years are in line or if there's something way off on the price. So that's what I'm doing there. You do see that you're paying a decent dividend. This dividend is averaging somewhere in the range of 40 to 60% of the EPS every year. So they're retaining quite a bit of money. They don't have to retain that much of their money to grow because they're not growing very quickly. They're able to pay a significant dividend out. That $2 dividend on a $78 price means you're basically getting like a 4% dividend yield. So that's important because you say 4% dividend yield plus a 6%, 6.5% EPS growth rate. You kind of combine those two numbers and you get a 10.5% potential return. So that's where I can easily say, hey, I'm going to get this double-digit return because I'm starting with the 4% yield and I'm still growing at that 6.5% rate. Now, ideally, you can't sustain EPS growth generally much faster than revenue growth over a long period of time without buybacks. So I'd like the revenue growth to be a little bit higher, but we don't see that here. The one other piece that leaps out, of course, is that I'm targeting this 15% return on equity or higher. And not only do I meet that on my 10-year average, but every single year individually in the last 10 years has also been above my 15% target. And the lowest year was actually 17%. So that's a very good sign as well. So overall, high quality business so far. If you're learning something, please hit that like button. I'm going to try and keep adding a lot of value because we're going to dive into this income statement, balance sheet, and cash flow statement. So I hope you'll stay tuned and consider subscribing by the end of this video. So income statement here. One of the things that you would want to check on is, in order to get that growth rate of EPS faster than revenue, is trying to see if you're growing your SG&A at a slower rate than your revenue. And it does appear that you are. Your SG&A is actually lower today by about 10% than it was at the beginning of the decade. So at the beginning of the decade, you had SG&A of $3.5 billion. Now you have an SG&A of $3.2 billion. So that's about 10% lower than it was at the beginning of the decade. But your revenue is actually higher. So your revenue is up 10%. Your SG&A is down 10%. That's just that little bit of operating leverage that's very helpful. Now, your gross profit didn't actually grow much, and so your cost of goods sold has kind of kept up and grown with the revenue. So that is a little bit of a downside, but this is why you've been able to grow your operating profit despite those concerns. You do have some distortions here because of the interest expense that they're paying. Of course, they had 15% of the enterprise value as debt. You're going to be paying interest on that, and that is an impact. But you can see that what they've been able to do with that operating leverage is kind of convert that pre-tax income faster into your earnings than you otherwise would, because it's 10, 20, 30, 35%, 35 to 40% higher pre-tax income by the end of the decade. You're talking about almost a 50% increase in your net income line, even though you've only had a 10% increase in your revenue. And that's all the operating leverage flowing down the income statement. Operating leverage is one of those key things I want to look for when I buy a business, because I want to be able to have that revenue growing at a good rate, but having that extra boost because of the operating leverage really helps. Now, you can't plan on that over the long term. You can't say, hey, I'm going to have operating leverage for 30, 40, 50 years. You might have it for some period of time, but it's never fully sustainable. You can't forever grow earnings faster than your revenue. It just doesn't work that way. But you can over short periods of time. And if you can own a stock during that short period of time, that can be very effective. One thing though, even though you've grown this faster, your EPS didn't even double in the decade, and EPS doubling in a decade would be about 7%, and you're a little under that. So, I mean, you'd really want to grow a little bit faster than this. It's not growing to that degree, which I'd really like to see. Now, you have retired about 8 to 10%, maybe 8% of your shares outstanding over the course of the decade, 666 to 613. So that's retired, 50 million of the shares. Let's call that, round it to about 8%. A little less than 1% a year boost from that. So you're getting some of this boost that we're seeing here from, let's call it, maybe 1% boost is from buybacks, and maybe a 3 to 4% boost is from this operating leverage. The operating leverage, of course, is not sustainable forever, even though but the buyback percentage might be. And so I would expect maybe some slower growth on the EPS line than we've had in the last decade, which is a little bit of a downside if you were considering this as a potential investment. Another piece that's really important if you're not really growing and you're kind of maxed out on revenue is that you don't continue to grow your PP&E, and we don't see that here. Your PP&E is basically flat over the course of the decade, and that's a pretty good sign. You do have an acquisition here from 2017 to 2018, so you see this big boost in goodwill and intangible assets. That additional $9 billion is, of course, mostly on the goodwill side. So they made a big acquisition here. Let's see if we saw a jump in that year for earnings. And you basically did. You went from 277 to 364. So you saw that did incrementally provide value to you as a shareholder. So that is a good sign as well. Balance sheet. Your debt's up about 50%, but it looks like the big jump in the debt was that acquisition, and they've paid it down since then. I like seeing that because that means they're kind of get back to a certain target range on their debt. They don't have a lot of cash there, so this is certainly a leveraged business. You don't have a lot of cash offsetting your long-term debt. Cash flow statement. The depreciation and amortization quickly leaps out that these two numbers are pretty well in line with each other. They're neither much higher or lower than the other across the board, which means that basically you're providing maintenance capital. You're not having to do a lot of growth capital. This is a pretty stable business. Stable businesses are pretty common in high-quality companies. High-quality companies often find it hard to grow, and so it's really hard to find that good, perfect balance of a high-quality business at a cheap price that's growing very rapidly. Often you have to have trade-offs. Here what we have is a high-quality business that's not growing rapidly, but it is stable, and it looks like it has a moat in these businesses. They took on this $6.2 billion in debt to make this $8 billion acquisition. You can clearly see that there, but then they've been paying down that debt over the next 4 years. It looks like they had stock buyback kind of in the first 5 years of the decades, but that's kind of really stopped, which would be, again, a concern for mine that I'm not really going to get that declining share count that I saw before, simply because they're not steadily buying back those shares anymore. You have been paying that dividend, kind of growing dividend every year for the last 10 years as well. Overall, this is definitely a high quality business. Not cyclical at all. Return on invested capital is telling me, hey, this is high quality. My 10-year median returns, this is high quality. The price is quite average, so it's a reasonable price for a high quality business. What's the downside here? The downside is just lack of growth. You're growing at 1% to 2% a year on the revenue basis, and we saw how some of the operating leverage that we saw over the last decade is not necessarily likely to be repeated. You can't plan on operating leverage continuing forever, especially when your revenue growth rate is this low. And your EPS growth rate is somewhat driven by that acquisition that was made. So you had that one-time acquisition. You had some of those buybacks, which just kind of tailed off as well. And so for me, although this is a high-quality business, the lack of high growth, and high growth would really be double-digit growth is what I really want to see. The lack of that growth is what would keep it off of my personal watch list, but I do think it's a high-quality company. It is at a reasonable price. You're probably going to get a pretty stable return. You're going to get a dividend. It looks like a good company from that side of the pass, but I'm going to pass on it for now. And if you learned something from this video, hit that like button. Please consider becoming a subscriber, working through every company in the S&P 500. And if you want to see the companies that I really like, the ones that made my watch list, check out the playlist up above. And that will be the link to the 40 to 50 stocks that have already hit my playlist or hit my watch list from the reviewing S&P 500 companies. These are my favorite ones. I think you will enjoy those videos. Now, if you want to support the channel, a great way to do so is to check out quickfs.net. My affiliate link is the first link in the description below. Signing up through that link is a great way to support the channel. You can get free or paid accounts and use this software online to study companies 10 minutes or less. Thank you for listening. Until next time, stop paying fees, start building wealth.